is Anna. Today I want to present you a presentation on the topic the gross estate. Learning objectives. The federal estate tax, the taxable estate, the gross estate, specific inclusions, valuation, gross estate, summary. The federal estate tax. The estate tax in the United States is a tax on the transfer of the estate of a deceased person. The tax applies to property that is transferred via will or according to state laws of intestacy. The estate tax is a tax on your right to transfer property at your death. It consists of an accounting of everything you own or have certain interest in at the date of death. Over there you can see the federal estate tax formula. The taxable estate. A taxable estate refers to the portion of assets and property that is subject to estate tax after a person dies. The size of a taxable estate will be determined by accounting for all assets less liabilities that the deceased possessed. The gross estate. Gross estate is a term used to describe the total dollar value of an individual's assets at the time of their death. A gross estate value does not consider his figured debts, owned, and tax liabilities. Once liabilities are deducted from a gross estate value, the remaining sum represents the estate's net value. Certain estates are required to report to the IRS and recipient the estate tax value of each asset included in the gross estate within 30 days of the due date. Example of the gross estate. At his death, Tyner owned a life insurance policy on his life that paid his wife $300,000 upon his death. The policy was only valued at $25,000 prior to Tyner's death. What amount, if any, is included in Tyner's gross estate? The gross estate is $300,000. Proceeds of life insurance paid due to the death of the decedent are specially included in the gross estate if the decedent owned the policy. One more example of the gross estate. At her death, Sylvia owned a real estate worth $400,000 and titled with her son in joint tenancy with the right of survivorship. The total cost of the property was $250,000. Sylvia contributed $50,000 to the total cost of the property, while her son contributed the remaining $200,000. What amount, if any, is included in Sylvia's gross estate? The gross estate is $100,000. For unmarried co-owners, the value of property owned in joint tenancy with the right of survivorship that is included in the descendant's gross estate is determined by the portion contributed by the decedent to the total cost of the property. In this instance, Sylvia contributed 20%. Hence, 20% of the $500,000 value is included in her gross estate. Specific inclusions. I'm sorry. The gross estate consists of the value of all property, real or personal, tangible or intangible, owned by a decedent or in which the decedent had an interest at the time of death. Generally, assets are included in the gross estate at their fair market value on the date of the decedent's death. Value of jointly owned property included in the gross estate. Generally, the full value of any property owned by the decedent as a joint tenant with the right of survivorship with another person is includable in the decedent's gross estate. Transfers within 3 years of death. In additional interest in life insurance, annuities and certain death benefits are included from the gross estate. Most transfers made within 3 years of death. Gifts are usually considered deathbed gifts if they are made within 3 years of a person's death. Gift taxes paid on transfer within 3 years of death. Under paragraph 2035A, certain gifts made within 3 years of the donor's death are included in the donor's gross estate. This rule minimizes the incentive for a decedent to transfer property shortly before death and thereby reduce federal estate taxes. Example of gifts of life insurance. 5 years before her death, Linda purchased a $250,000 term insurance policy. 3 years before her passing, she irrevocably transferred the policy and all incidents of ownership to a trust which paid the last 3 years' premiums. Linda's gross estate included $100,000 of proceeds since Linda paid 30% of the premiums. In this example, $100,000 will be included in Linda's gross estate because she made 2 of the 5 premium payments. 2 of 5 is 40%, so 40% of the $250,000 proceeds is $100,000. Valuation. Valuation is a process of determining the present value of an asset. Valuations can be done on assets or on liabilities. Let's talk about example of the valuation. Mark transfers property to an irrevocable trust, retaining the income from the trust for 5 years, at which time the trust property will be distributed to Aaron. Which of the following will result if Mark dies during the 5-year period? As you can see, all of the trust property will be included in Mark's gross estate as the date of death fair market value. Gross estate summary. The decedent gross estate consists of the assets subject to probate as well as certain assets transferred outside probate. These latter assets included a property owned by the decedent in joint tenancy with the right of survivorship as well as life insurance. The gross estate also includes certain property transferred by the decedent within 3 years of death and certain future interest owned by the decedent. Conclusions. Today we talk about what is the federal estate tax. We defined what is taxable and gross estate. In this presentation, we talked about the gross estate specific conclusions and valuation. There are sources that I used, and thank you for your time.